Hello everyone, this is Tejas from Trendline, and in this video we'll look at two investing strategies for 2023. Investors are always looking to beat the market to generate alpha, excess returns on an investment above the benchmark index. But this is not an easy feat, especially in the long term. Several factors ranging from macroeconomic risks to firm-specific risks affect investors' portfolio. This is even more difficult in a volatile market as investors are unsure of the direction of the market and react quickly to its rise and fall, which makes it harder to generate returns. In this video, we'll talk about two investing strategies, momentum strategy and growth strategy. Momentum strategy focuses on the recent price changes and technical bullishness of a stock, while the growth strategy looks for companies with strong fundamentals and high growth rates. To summarize, momentum strategy outperforms growth strategy in terms of overall returns quite easily. But with higher returns, risks also increase. In volatile markets, growth strategy performs better when it comes to losses and drawdowns. However, in a bullish market, the momentum strategy manages to perform exceedingly well. Let's understand the screener used for each strategy and then look at the optimal combination of variables like how often you should review the portfolio and the best stock weightages for using Trendline's backtesting tool. It is important to note that historical returns are not predictive of future returns. It provides an idea as to how the strategies have performed historically. We will then analyze the best performing strategy individually and then compare the two. We'll finish by looking at the risk and return measures. This strategy mainly looks at stocks with high trendline momentum scores. The momentum score identifies the bullish or bearish nature of a stock. Stocks with high momentum score, which is calculated daily from over 30 technical indicators, show positive share price movement, volumes, and sentiment. These stocks have a momentum score of at least 70, and the screener includes stock with high trade volumes on exchanges to ensure tradability. This screener is then optimized to show 5 stocks with the highest momentum score. Users can change this on trendline.com by clicking on Advanced Options button. This strategy focuses on a company's fundamentals and with emphasis on earnings growth. These stocks have high durability and Piotrowski scores, indicating solid financials over the long term. To account for the growth aspect, EPS TTM growth is greater than 30%. The screener is then optimized to show 5 stocks with the highest TTM EPS growth. Let's now see how Trendline's backtesting tool can be used to optimize the strategy. Two main variables that can be tweaked are portfolio review frequency and stock weightage. Portfolio review frequency indicates how often an investor needs to review the portfolio, and the stock weightage represents the maximum number of stocks in a portfolio. When the momentum strategy is backtested, keeping the 5 stock limit constant and by changing portfolio review frequency, we can see that a weekly portfolio review or change works the best compared to monthly and quarterly review. The maximum drawdown is lower for weekly review as investors can cut the losses in case of a sharp fall in one of the stocks. Maximum drawdown is the biggest observed loss from a peak to a trough of a portfolio before a new peak is attained. This is because the momentum score is sensitive to recent stock price changes. Hence, reviewing the portfolio every week works the best here. Now, if we keep the review frequency constant at weekly and change the stock weightage, the backtest shows that a 5 stock cap with 20% weightage each gives the highest returns. However, it is important to note that the drawdown for 20% stock weightage is also the highest due to a more concentrated portfolio. We can set portfolio review frequency to be done weekly and stock weightage of 20% for the optimal momentum strategy. Long-term and short-term returns for the optimal momentum strategy can be checked by looking at the backtest results. This strategy performed the best in the 1 year time period, generating about 554.3% returns with a maximum drawdown of 24.6%. Since this strategy requires bullish momentum in the market, its long-term CAGR is lesser than the shorter term with higher momentum. Volatile markets in particular may lead to less than expected returns from this strategy. For example, let's look at the period analysis, which shows the returns over every single period. We can see that this strategy has higher drawdowns in falling and volatile markets. In the past week, a portfolio following this momentum strategy fell 6%, underperforming the Nifty 50 by around 3.5%. However, over the year, returns from this strategy have performed exceedingly well when compared to any benchmark. We will now choose the best performing growth strategy by trying different combinations of portfolio review frequency and stock weightage. First, let's see what happens when the 5 stock limit is retained and the portfolio review frequency is changed. Since this strategy focuses on the fundamentals of a company rather than the momentum, a quarterly review strategy performs the best in comparison to monthly and half yearly reviews. Notably, the maximum drawdown is very marginal, showing high resilience even in volatile markets. Like the momentum strategy, the five stock cap or stock weightage of 20% works the best here as well, generating higher returns compared to a 10 or 15 stock limit. Looking at the variables, we can see that a quarterly review portfolio with a maximum stock limit of 5 is the optimal strategy when we take the fundamentals and growth aspects of company into account. We can now check how this particular strategy performed over 1, 3 and 5 years. Starting with the 5 year time period, this has the highest drawdown due to the crash in 2020. However, it is still quite low compared to the 30% drawdown of the momentum strategy over the same period. The drawdown numbers of 1 year and 3 year time periods are almost negligible at minus 1.3%. The period analysis also confirms the same. Over the past 3 years, this strategy has given negative returns in only 1 quarter, and that number is marginal at 1.3%. In the past quarter, though the Nifty 50 has been volatile and fell over 6%, a portfolio following this strategy was still in the green. Now that we have analyzed the optimal strategy in momentum and growth aspects, it is clear that momentum strategy leads in returns. But this is not the only factor that an investor needs to focus on while choosing a strategy. One has to consider the risk associated with the strategy, which can be measured in maximum drawdown, period analysis, and winners to losers ratio. Higher returns mean higher risk. The risk associated with momentum strategy can be seen with a high drawdown of around 25% for its optimal portfolio over 1 year. Meanwhile, growth strategy's maximum drawdown was just 1.2% over the past 3 years. Period analysis charts also show that the momentum portfolio saw way more negative returns period when compared to growth portfolio. Of course, investors can put stop losses which limit drawdowns. Since these strategies are automated, no stop losses were included. Another important factor is that the growth strategy includes stocks from the Nifty 500 only, while the momentum strategy includes all listed stocks. Though the momentum screener includes stock with high volumes to ensure smooth tradability, sometimes micro or small cap companies could hit the upper circuit in the pre-market trading itself, which means investors may not be able to buy the stock when actually needed. The same applies to stock exits as well. When a stock gets stuck in the lower circuit, considering all the factors, investors can choose the strategy based on their personal risk and return measures. A risk taking and active investor interested in financial markets and willing to review their portfolio weekly would find the momentum strategy suitable. One can set up alerts on trendline screener to be notified of any entries and exits in the screener. The growth strategy would be more suitable for a risk averse investor. Also, investors who are not inclined to review their portfolios every single week will find it easier to follow a strategy with a quarterly review. In volatile markets, a growth strategy with lower drawdowns is more attractive. So in this video, we looked at two investing strategies with different investing philosophy and high returns over the years. Trendline users can create their own strategies using the screeners and available parameters. Users can also backtest these strategies using variables like portfolio review frequency and more to analyze their historical returns. This video is just for educational purposes only, and investors have to do their own research before investing. This is Tejas signing off.